Institute for the year 2022, which promises to be, as they say, an interesting year. Today, we will talk about financial markets and especially emerging markets and the interaction between investment patterns and emerging market outcomes based on very pioneering research by Anusha Chari. Anusha Chari is professor of economics and finance at the University of North Carolina in Chapel Hill, UNC. She studied economics initially at the University of Delhi, then at Balliol College, Oxford, got her PhD in international finance at the Anderson School of Management at the University of California, Los Angeles in 2000. Then she taught in different universities at Chicago Booth in Chicago and at the University of Michigan. She also had visiting positions in the meantime at St. Gallen in Switzerland, at the Haas School in Berkeley. And she joined in 2008 the University of North Carolina, where she teaches now. She also has a lot of policy experience. She's worked at the IMF. She's worked in the Economic Advisory Council of the Indian Prime Minister. She's now presently a non-resident senior fellow at Brookings, and also importantly, the chair since the beginning of this year of the Committee on the Status of Women in the Economics Profession at the American Economic Association. Alejandro Werner is well, maybe first and foremost, a non-resident senior fellow at the Peterson Institute. He's also the founding director of the Georgetown Americas Institute at Georgetown University. He got his BA in economics at the Instituto Tecnológico Autónomo de México, ITAM, and his PhD also in economics at MIT in 1994. He had a career at the IMF and in Mexico, at the Bank of Mexico as early as 1988, also advisor to the Minister of Finance in the late 80s. Then he was a visiting scholar at Yale, also at the International Monetary Fund for first time in the mid-90s at the research department. And then he was again at the Bank of Mexico, director of economic studies until 2003, and then in the Ministry of Finance, once again, where he was Undersecretary of Finance, basically head of economic policy between 2006 and 2010. After that, Alejandro went to the private sector. He was head of corporate and investment banking at BBVA Bancomer, one of the main banks in Mexico in the early 2010s. And in 2013, joined the IMF again, where he was director of the Western Hemisphere until last year, when he joined the Peterson Institute, and as I said, the Georgetown Americas Institute. So with that, over to you, Anusha.
Thank you so much, Nicholas, for that kind introduction, and it's a real pleasure to be here. So let me go ahead and share my screen, and we can get started. Can I have a thumbs up that you can see the full screen? Perfect. So as Nicholas mentioned, what I'm going to talk today about the topic is whether index funds have implications, particularly harmful ones, for global financial stability. And so let me just sort of begin by giving you a few facts, which is that what we know is that professionally managed portfolios, what are popularly known as NBFIs, are now a key driver of cross-border capital flows to emerging markets. So this includes pension funds, hedge funds, private equity, money market funds, but very importantly, mutual funds and ETFs, or exchange-traded funds. And what we see is that mutual fund and ETF assets under management rose from about 69 billion in 2003-2004 to about 1.15 trillion. So in about the last 15 years, there's been this manifold increase in mutual fund flows to emerging markets in particular. And within those mutual funds, we can look across asset classes, and what we see is that while bond funds were only about 15% of the total flows in 2004, so that's about 11 billion, they have sort of increased, these flows have increased in value to about 383 billion. So the split between equity and bond funds used to be about a 15%, 85% split. And now when we fast forward about 15 years, we see that the split is now more a 1/3, 2/3 split, with equity funds accounting for about 759 billion of that 1.15 trillion. So these are sort of significant values in terms of assets under management. And furthermore, what we see is when we look within these funds or look at the granularity of these funds, we see that passive index funds and ETFs, which have little managerial discretion, account for about 50% of this emerging market space. Actively managed funds, on the other hand, enjoy considerable discretion. And we're going to try and see whether this benchmarking that is introduced via passive index funds has implications for global financial stability. So just to very quickly show you some of the funds that we were focusing on in our research, we have active equity funds. So the TIAA-CREF Global Equities jumps out. Passive equity funds, including the Vanguard class of funds, active bond funds, PIMCO being very prominent, and then passive bond funds, which again includes the Vanguard family of funds and JP Morgan US emerging markets. The point to note here is that according to Vanguard, about 40% of the retirement plans that they offer have some exposure to emerging markets, and these mutual funds are low-cost vehicles that provide households domiciled in the US, for example, to access or exposure to emerging market assets. Another feature is that these investments are very liquid. So we can basically have subscriptions and redemptions in response and quickly liquidate or get into these funds. Now, what we see is this was sort of a picture that was doing the rounds in the early days of COVID-19 in March 2020, March, April. What we see is that if we look across different types of stress episodes, so the global financial crisis, the taper tantrum of 2013, the Chinese stock market crash in 2015, and then finally COVID-19 in 2020, we see on the left-hand side the outflows from emerging markets. And on the x-axis, we have the days from the shock, what we're calling the shock. And what should immediately jump out is that in terms of flows, there are very, very abrupt adjustments during times of stress or crisis. And if we look on the right-hand side, we see that valuations or returns also have very abrupt negative adjustments in response to these shocks. So, you know, we were sort of, in our research, we were really thinking about, well, what is driving these abrupt adjustments in response to stress or adverse shocks? And previous research has shown that mutual funds represent an important shock transmission mechanism. So what that means is that when mutual funds get funding shocks from the investor base, which could be households or other retail investors, these global funds substantially alter their portfolio allocations to emerging markets in particular. And this sort of picture helps to illustrate what I'm talking about. And if we focus in the center of the picture, we see that if we look at the open-end mutual fund organizational form, their assets are in emerging markets, which tend to be pretty fairly illiquid equity investments and quite illiquid bond investments. And then they hold some cash reserves, which if they increase the weight on cash reserves, acts as a drag on performance. On the liability side, these are these investor funds that I was talking about from retail investors, which are subject to on almost a daily basis, subscriptions and redemptions. So these liabilities are very liquid, but the assets tend to be very illiquid. And then on the back end, we have these shocks that to global investor risk appetite. So what I suggest is that shocks to global investor risk appetite can actually create tail risk in emerging markets. So let's say there's some sort of shock to risk appetite, consumer confidence declines, or investor sentiment declines. This can very quickly lead retail investors to redeem their open-end mutual fund investments in emerging markets, and then the funds themselves, fund managers, have to then, if they run out of the cash buffer, they have to engage in buying and selling of emerging market assets, which in turn has an effect on the price of these assets. Now, if other funds that are also invested in these emerging markets see valuations go down, we can have a price liquidity spiral, we can have herd behavior, we can sort of generally have turbulence, because once the returns start going down, you can have further redemptions, which leads to what I'm referring to as a price liquidity spiral. So the idea here is that these mutual funds, just by way of their organizational form, illiquid assets, liquid liabilities, have sort of intrinsic fragility built into them in terms and with implications for global financial stability. And I'll just sort of point out that, as I mentioned earlier, we have active and passive funds. Passive funds benchmark to indices such as the JP Morgan MB or the MSCI World. So investor sentiment shocks, as we saw on the previous slide, can interact with the redemption structure of open-end mutual funds. And the reason for this is that fund benchmarking, which also is a factor that goes into the performance evaluation of fund managers, is pervasive. And what this does is it introduces a very high degree of conformity in these passive global fund investments that can drive herd behavior and elevated cross-market correlations in emerging markets, which can lead to correlations. And what we see when we examine these stress episodes or tail events in emerging markets is that passive fund flows appear far more responsive to global shocks, and this in turn can induce elevated correlations. And if it is the case that these fund flows amplify these global shocks and cause turbulence in emerging market equity and bond markets, it stands to reason that they can pose significant financial stability concerns. The idea here is to just note is that this is just coming through passive benchmarking. It's very mechanical. And the data suggests, so the red series or the bursts in red that you're seeing are shocks to investor sentiment, and the blue series, which is sort of showing us shocks to macroeconomic fundamentals, which introduces uncertainty in financial markets. So it's a combination of risk sentiment and macro uncertainty that can drive these global risk shocks, which in turn feed into subscriptions and redemptions, and then liquidations from emerging markets or surges into emerging markets. So if we look at the mutual fund space, EPFR has a great data set, which has over 14,000 equity and 7,000 bond funds with assets under management of greater than 8 trillion. And we can look at the—
I'm sorry to interrupt. I have to do my job here. We're almost at 10 minutes, and this is fascinating, but I will suggest that you move as quickly as possible to conclusions, and then we may come back to some of the data in the meantime. Thank you.
Sure. Anyway, so we have a bunch of different investment destinations, and we can use this data. And you can just see on the left-hand side, we have passive funds, and we see that, just looking at the responses, we see that passive fund redemptions are far more responsive to shocks to global investor risk appetite compared to active funds. So once again, what we are suggesting is that what this implies, the data suggests, is that significant fractions of mutual fund flows are due to funds, these passive funds that have little or more, little or no discretion. So let me sort of just conclude by just giving you a brief summary of what I've said today, which is to focus on shock transmission via global fund reallocation And the fundamental idea that I'm putting forward is that if global investor risk appetite wanes or increases, in the face of global risk shocks, global investors rebalance their portfolios away from or towards risky assets in emerging markets in particular, and towards safe assets. And so what I'm suggesting is that these global risk-on, risk-off shocks have important implications for returns, asset price determination, and global asset allocations in risky emerging markets. And tail risk, or extreme capital flow and return realizations, are tied to global risk appetite. And what I'm suggesting is that it is the fund management machinery, the assets and liabilities, the liquidity mismatch that is responsible or is a factor in global financial instability, and that this is the machinery that is increasingly facilitating cross-border investment. So I'll just stop there.
Thank you so much. I have tons of questions, but first, Alejandro.
Thanks, Nicolas, and thanks for the invitation, and thanks, Anusha, for giving us a great presentation on a very interesting topic around, these transmission mechanisms of global shocks to emerging markets. I will try to use my 5 minutes to try to ask the policy questions that come to my mind when reading your papers and seeing your presentation. And I think the first one, that it's the broadest one, is basically, as a policymaker, do you think this excess volatility that now countries are importing from passive international funds, it is worth taking it vis-a-vis, I would say, the advantage of a significant increase in the demand for the country's assets? I think at least when I was doing policy, we bend over backwards to get into the indexes. And I think we always did that thinking about first moments, not thinking about second moments. So should we would have needed to think more about the second moments, and can this second effect be even more important, and therefore countries shouldn't be so focused on attracting this type of investors? I think that's, to me, that's an important policy question. The second one, and tied to this one, is basically a broader analysis that it's obviously beyond the scope of your paper, but I think it's within the scope of your research agenda. What's the overall effect of these investors on volatility in local markets? How do these investors, vis-a-vis active investors, react when confronted, for example, with domestic shocks, or when confronted with contagion from other EMs? Are these investors actually contributing to reduce EM to EM contagion? Are they also contributing to reduce reactions to local shocks? And in that sense, maybe the overall effect or the unconditional variance should actually be reduced with the entrance of these investors. I think that's the broader policy question. The fourth one is any ideas on how policymakers, central banks, should react to these shocks? And I think this is a very interesting issue. I think at the IMF, our first gut feeling was let the exchange rate move, and if not, use interest rates. Obviously, I agree with that. But if exchange rate movement generates other type of effects on inflation expectations, etc., how do you want to address them? Through interest rates? Are these redemptions sensitive to any movements in domestic interest rates? I don't think so. So maybe, there's a scope, given this empirical result, to be more active on FX intervention. The issue of CFMs, I think it's more tricky, because it will also limit the inflows in good times. So I really do not know, but I think there's scope to think a little bit deeper about what now the IMF calls the integrated policy framework, using FXI, using CFMs, etc., to basically manage these larger shocks coming from global liquidity shocks.
Sorry, Alejandro, in addition to being as a time police, I'm the acronym police here. CFM, I think, is capital flow measures, right? And what was the other acronym you mentioned?
Maybe I said FXI, that it's
foreign exchange intervention, right?
Sorry.
Okay, sorry.
Yeah. So maybe another question is policy recommendations for the people including EMs in these indexes. Are they actually looking at the right thing? Maybe they're looking at liquidity, because I mean, to be included in one of these measures, these companies look towards liquidity, depth, blah, blah, blah. But I'm pretty sure they're looking at the mean and not at the tail events. So maybe there should be some recommendation that they should be looking at the third decile or other moments of the distribution beyond just the liquidity in normal times, because maybe time varying liquidity in emerging markets, it's a much more important problem than in other markets. And therefore, before introducing one of these markets into the indexes, it will be good to do that. And just to finish, I mean, just specific issues on your slide 4, that is the one that many of us used. I mean, we present the reaction of flows to each of these shocks in absolute magnitudes. It might be good to look at them proportional to the size of the portfolio, and maybe the difference between each of the shocks, it's a little bit smaller. And maybe the public was a little bit puzzled about that positive or reaction in the different direction on one of the tails of the distribution of your coefficients that maybe raises some eyebrows, and it might be interesting to explain. So with that, I close my comments and saying it's a very interesting presentation and a very important topic. Thanks.
Normally, I would go directly to the Q&A with questions from the audience, but Alejandro's questions were so important that I think, Anusha, you get to answer them before we can move on.
Okay, perfect. Alejandro, great points that you brought up. They're all extremely important because they highlight some pretty tricky trade-offs, right? So in this research with my co-authors, what we were trying to do is to take a deep dive into tail risk, because a lot of the policy conversation is always about myopic foreign investors who run for the gates as soon as there's the first sign of trouble, right? And I think what our findings suggest is that this tail risk, there might be just a very mechanical component to it, right? That in the face of redemptions, these passive mutual funds are, they're obligated to sort of liquidate their emerging market investments, right? The second point I want to make, so I'm absolutely with you that I don't think this means throwing the baby out with the bathwater. And the access to capital in capital scarce emerging markets is really extremely important. And so, capital flow measures, for example, they can be easily circumvented, and I'm just not sure what sort of efficacy they have. So this access to capital point that you raised is extremely important, but what it points to immediately is to destination heterogeneity in terms of country fundamentals, right? So it's not just the global shocks. What we see is that with the active funds, which is 50% of the emerging market space, they're not really reacting to the global shocks, right? So it completely goes to your point of, well, what are they reacting to? And it's really the fact that they are more in a position and have the flexibility to focus on the country play, right? So if they're able to stay in even in the face of these global shocks. So I think that here for them, the overall volatility in the local markets can matter. And it would be interesting to see what this point that you were suggesting about contagion, that in response to a shock from a country like Peru, do these funds start to redeem their assets from Mexico and other countries in Latin America, say. And there is some evidence to show that when, for example, Brazil put on capital controls, so in the other direction, then the fund flows basically found their way to other South American countries, right? So there was this redirection of capital in response to the capital flow measures in say, Brazil. Now, I was sort of recently looking at an IMF blog about, how should policymakers respond, because there is this concern that if there is normalization and rate hikes in the US over the next year, and some of these are more unexpected and abrupt, then that's going to cause some turbulence in emerging markets. And the IMF view seems to be to encourage emerging markets to let their current currencies depreciate and to raise interest rates. And also, if there's some fiscal space, to kind of deal with the turbulence in that way. In terms of the reactions to domestic policy shocks, what we do see is during the earlier QE episode after the global financial crisis, when the zero lower bound was reached in the US, we saw this, what they called a monetary tsunami into emerging markets, right? So when interest rates, you see this returns chasing behavior or search for yield when interest rates in the US are very low. So, the policy rates in these countries actually do matter in terms of attracting capital. So I think it's a great idea that you suggested, that rather than just looking at these investability criteria, which tend to be, are the firms that are being included into the index, do they meet a certain size criteria or liquidity criteria in a sort of static way? I think it's a great policy recommendation for fund managers to actually be looking at the time varying liquidity in emerging markets as a criteria for index inclusion. And I showed you the picture of those abrupt outflows from emerging markets. What we tend to see is that when the surges happen, they tend to be a little more slow moving. So it's not quite so dramatic. So I'll just leave it at that. And Nicholas, we can go to Q&A, or unless there are other comments.
I have a first question from an anonymous attendee. In that case, don't at least some of those passive funds have their own limitations on the frequency of outflows, and how much of that does it play? How much of a role does that play in the phenomenon that you're looking at?
Right. So this is absolutely correct. Like, if you have a Vanguard investment in your pension portfolio, for example, if you do a redemption in particular, you are, there's always a sign that flashes up saying that you may not be allowed to go in for X period of time, right? So they do try to limit the volatility, but by and large, in response to a large enough global shock, like we saw during the COVID-19 crisis, there is a one-time redemption that all the retail investors would have access to. And that's exactly what we are sort of talking about, is this tail risk of big shocks and the impact that they can have on redemptions.
Sorry, I need to unmute myself. Also, there's a question on what is really driving the volatility. So if, let's assume that there is a way to reduce the share of index funds and passive funds, would the same investors that invest in those funds use active funds to take a top-down view and have the same kind of knee-jerk responses to changes in risk appetite as you see now? In other words, how much does come from the fact that they're passive versus just the risk preferences of investors? How do you measure that?
Absolutely, it's sort of completely points to the fact that the investors, the retail investors who are willing to invest their retirement savings into an active fund have somewhat different risk preferences compared to those who are going into passive index funds, right? And so the question of whether if the passive funds were not available, would these same retail investors go into active funds? I'm really not sure, because even when these funds were introduced, they were mostly in the active category. The passive fund investment space has sort of expanded over time, which, as I mentioned, that fact that Vanguard says that 40% of retirement plans now offer emerging markets exposure, that was not the case 20 years ago, right? You had to really actively go and seek out international, forget emerging markets, just international exposure. I remember, when right after I got my PhD and I got, my first, got to make my first pension allocations, anytime I tried to go international, these big warning signs would pop up. And this was, Vanguard and TIAA-CREF, and they were like, are you sure you want to make this international investment? These investments can be risky. And there was almost this pressure not to make the investment. And I'd be like, well, I study international finance. I think I want to invest in emerging markets, so please let me do it. And then, so it's really not clear, right? Like now they've become much more a part of the investment space. So if you have a conversation with a sort of financial planner, they are sort of pushing international investments, including those in emerging markets, which I think is a welcome sign, because as Alejandro mentioned, these countries are capital scarce and need access to these investments.
Questions which are really to explain the results, the categories, the results. So I will keep directing them at you, Anusha, and then ask Alejandro to react to the different points in a more holistic manner. There's a question from Anderson Capital Silva, which is passive mutual funds versus ETFs. Have you checked whether there's a difference in the reactions? Is there an effect of composition of these funds between domestic and international investors? Can you give us more about, the taxonomy of the funds themselves?
Yeah, so that is actually on our agenda, to kind of look at this heterogeneity across ETFs and just the pure mutual fund space, to try and see whether the ETF reactions are somewhat different. There is other research by Thomas Williams, who's at George Washington, GW, which basically shows that this ETFs play an important role, and index inclusion in terms of ETFs do play an important role in terms of both the flows as well as the returns reactions. But that is sort of our next step, to try and look at the difference across ETFs and passive mutual funds in the context of tail risk.
And I should have applied acronym discipline to myself. So of course, ETFs are exchange traded funds. There's a question from Christoph Walkner, who asks, I understand that the data says that passive funds react more when compared to active funds, but not clear why this is necessarily the case, because active funds are also benchmarked as are passive funds. So can you elaborate a bit on that difference? Yeah,
so one thing I'd like to mention is, and that surprised us, is that, when you have, say, an MSCI World Index, we know the weightings, right? What are the weightings that are attached to different countries? And so we could look at the weightings in the MSCI index and compare it to the passive fund space as well as the active fund space. And one result that we were not expecting, we were expecting that active funds would have weightings that would be sort of somewhat different from the benchmark. We found that the weightings themselves were quite similar across active and passive funds. So it wasn't the case, it wasn't necessarily jumping out from the data that these active funds on average are making very specific country plays, just if you look at the weightings attached to the different countries. So the portfolio allocations tend to look very similar. But when you see that picture that I showed you, passive funds are more responsive, right? So there's something going on there that in response to these global shocks, active funds have greater flexibility to just stay in those investments, whereas these passive funds seem to be responding a lot more. But in terms of allocations, we were sort of somewhat surprised to see that they are pretty closely benchmarked to the prominent indices.
Next one in the series, a question from Ted Truman. Actually, he mentions that it might have been in the slides, but is the focus here on amplification to risk off for one country or the spread to other countries? Can you detail again the risk off definition?
Yeah, so what we have is sort of panel data, right? So we have flows to countries over time, and then we're averaging across countries. So the tail risk that you see is sort of comprehensive. It's on average across countries, what we are seeing in terms of net inflows or outflows. So that is what constitutes the tail, which is the aggregation of these sort of outflows or inflows, and they include all these different countries.
Alejandro, any reactions on all these points? I mean, many of them are about clarification on the research, but anything that comes to your mind?
And just to add, in your sample, average returns for active and passive funds, how that different plays out. And secondly, it seems that for what you were saying, I mean, assuming that maybe active funds have a slightly higher average return, and I don't know if that's the case or not, but you say portfolio allocation seems to be very similar. Then I think the conclusion that comes out of that is that basically active funds really have more flexibility to take advantage of specific opportunities. Some of them is this mechanic reaction to global shocks, and other ones might be going into slightly more risky assets at the margin, maybe with 5%, 7% of their portfolio, and going into lower rated sovereigns, and maybe some specific plays with quasi sovereigns that maybe pay a premium over the sovereign, and maybe there's an implicit guarantee, so they play with those kind of more less plain vanilla kind of trades. So where do you see the difference, that it's not on the average portfolio allocation?
Yeah, it's not on the average portfolio allocation. It's just, what we're getting is basically in response to the shocks that we're seeing, that these active funds are actually able to make somewhat of a country play, right? And if you talk to policymakers, and I think you would also agree that there are the fund investors who are looking for the more plain vanilla returns will go for the safer countries, right? So if we just look at sort of South America, Chile or Mexico provide safer plays than or more stable plays compared to other countries like Argentina or Peru or Ecuador. And so you do see that the class of investor who is willing to go into countries with, let's say, more risky fundamentals, they are different. And it does look like this country heterogeneity, right? So we've just been talking about global shocks, which are exogenous to these emerging markets. But when we think about active plays, the country heterogeneity is really something that we need to sort of look at the interaction between what are the policy measures a country is taking, or what are the destination country fundamentals. And in our sort of research, we are controlling for domestic policy rates and growth prospects. So the findings that we see are really after controlling for what we call these pull variables, which are destination specific fundamentals that can alter the risk return calculus and inform portfolio allocations, or whether this is going to lead to rebalancing in response to a global shock. And it is sort of interesting that even the IMF is sort of saying that the countries that may be subject to the most turbulence in this coming year with possible rate hikes from the Fed is are countries with weaker fundamentals, right? Countries with weaker institutions, countries with big current account deficits already, big countries with a lot of exposure to foreign currency denominated debt, and so on. So even in terms of how this turbulence translates, we could see differences across countries conditional on their own macro fundamentals and their own policies.
This is a great conversation, and it's also triggering a lot of questions from the audience. So let me take a few in a batch, and you can give relatively succinct answers if they're easy to answer. Up to you, Anusha. There's a question from Majid Bazarbash asking the distinction between different tail shocks. Do you also study domestic factors triggering a tail shock, or just exogenous tail shocks? And do you see significant differences in the response? There's a question. I'll put them all together, and then you can, address them the way you want, because I'm mindful of time, and I have also additional questions. One question, whether you have looked at how this would play out if you looked at advanced economies instead of emerging markets, and how the results would differ. There's another question saying, you mentioned higher conformity in global investment. So do you mind digging that wording and how conformity is measured over time? Is that just referring to benchmarking impact, or do you see conformity on the active side too? This echoes a question we already addressed, but I think it's interesting. There's a specific question on country weightings versus company weightings within a portfolio. They're not necessarily the same between active and index portfolio. Have you been able to examine this distinction?
Sorry, can you repeat that one? This one that you just said?
Country weighting versus company weightings.
Mm-hmm.
If you have explored these differences in that was when you were commenting specifically on weightings in response to a previous question.
Mm-hmm.
Another question: do you have the impact on domestic stocks given the huge size of domestic ETFs? I'm not sure what country or countries the questioner has in mind here, but you may be able to figure it out. And then I think the last in this list, a question from Philip Reading. Normally, asset price volatility is not enough grounds to speak of financial instability. So how do you think about that distinction between volatility and instability? Or would this be the case that it's the same thing in emerging markets, if you think so? So sorry, this is a broad set of issues, but again, mindful of time, it probably makes sense to take them all in one batch.
Right. So so let me just sort of take a crack at this, and I'm sure I would love to get Alejandro's views on this as well. So let me sort of talk
by the way, when I mentioned domestic, the questioner has clarified in the meantime that he or she was referring to the US.
Yes, so that's exactly what's happening, right? So the domestic, what we are calling global, is actually domestic US shocks. So these funds are domiciled in the US or Europe, and so the shocks that we're referring to are, say, empirically, this could be corporate spreads widening in the US, or advanced US stock market volatility, or it could be the VIX index, or it could be corporate bond yields. So all of the shocks that we are referring to are indeed, these global shocks are indeed domestic from the perspective of the US and advanced economies. And so that is what we are saying, that these shocks that are coming from outside these emerging markets are actually impacting tail risk. And and then that is over and above whatever is going on in the destination, right? The policy rates and the growth prospects in the destination. We also, like in our estimations, we also use the Citibank's Economic Surprise Index, which is available on a daily basis, and it's giving you sort of information about policy surprises that could be originating from emerging markets. So it's after controlling for all of that, taking all of that into account, we're looking at what happens from the perspective of a U.S. rate hike, right? So U.S. monetary policy tends to have an important vector of transmission of either flows into or out of emerging markets, as we saw in the case of the monetary tsunami that was, it was called popularly the monetary tsunami in the post-global financial crisis, or the taper tantrum when the first announcement of potential tapering was announced. The point about advanced economies is actually a really interesting one. So in this study, we have focused on emerging markets because we see these outsized responses, but I want to go back to something that Alejandro brought up, which is that, the fact that these countries are being subject to these shocks that are coming from institutional investors that are domiciled in advanced economies, does this mean that, this capital ought to be regulated in some way? And the point that I want to make is that given that the institutional strength in the emerging markets matters so much for attracting foreign capital, I think it's important to remember that money sloshes in and out of the US or the UK or other advanced economies all the time. And then we're not sort of, throwing our hands up and saying, oh, look at these myopic foreign investors, right? We don't have that conversation. And my sort of take on it is because the financial markets here are so deep and well developed. So the lesson for emerging markets is not control this foreign capital from coming in and out, but sort of focus on building up institutional strengths, building out, financial market depth, building up the financial markets so that they become sort of, they are deep, they're well functioning, and then these markets may be, that sort of constitutes strong fundamentals, which in turn would make them less subject to the kind of volatility that we see. So the conformity that we're talking about is purely the country weightings. And so as I mentioned earlier, the active funds also seem to have very similar weightings. Now, what's interesting is we know that if you read the MSCI sort of prospectus, or, we know that they place, outsized weights on certain companies within countries, right? Alibaba has some crazy sort of weight attached to it. I think that, we would love to look at those company weightings, but what we have access to is the country weighting data. So we're sort of somewhat stymied in our efforts in that we cannot look at, what are the particular companies. But I'll tell you from previous work that, again, it goes back to what Alejandro was saying, that, should they just be looking at liquidity and size? But some of these investability criteria are simply just, liquidity, did they trade for 2/3 of the trading days that the stock exchange was open? And do they cross a certain size threshold, especially like, their pension fund investments, these size and liquidity criteria statically sort of matter a lot. But, this time varying idea that Alejandro brought up is extremely interesting. Now, the domestic stock impacts, that's exactly what we're looking at, right? We're looking at how do valuations in emerging markets respond when, capital either flows out or flows into these countries. And we find very sizable effects, so in response to outflows, prices tend to fall a lot. That can lead to more redemptions, which in turn can lead the price to fall further. Now, the actual impact really does depend on the savings pool. So if you think about a country like India, for example, there's a big savings pool, and it's been in sort of, in sort of CD type investments. But now you can see that when foreign investors are selling, it is these investors who can sort of start entering the stock market, and a deep pool of domestic savings actually matters for the kind of price impacts that we see. Because people always ask, if the foreigners are selling, who's buying? And it really depends on whether the domestic households have the savings that can be deployed in this way. And it's a great question about, is it, should we just be looking at the second moment, right? Should we just be looking at asset price volatility? And that's exactly why in this research, we're not just focusing on the first and second moment, we are focusing on skewness and kurtosis, which is what constitutes tail risk. And what we find is considerable sort of right skewness, which is in the direction of downside risk, and a lot of kurtosis, which is very long tails, right? So if you have a distribution of flows and returns with very long tails, what that suggests is that if you have a long tail, it means that extreme events not only become more probable, they also become more destabilizing. So we are definitely focusing on that skew, which is fat tails, long tails, which kind of gives us a sense that we're moving beyond just looking at means and volatility. So I will leave it at that.
There was a lot to unpack here. Alejandro.
Not much on my side, just to maybe repeat what Anusha said on the importance of developing a deep local market with a deep local investor base that will actually allow you. I mean, at the end of the day, those are the investors that will not be subject to the liquidity shock that is affecting the global investors. Secondly, those are the investors in which, for example, if the first shock absorber is the exchange rate, they're looking at a long-term return in domestic currency. So the last thing they want is to switch to foreign currency if they see a stable nominal system in your country. So in that sense, those are the investors that will take the opportunity to come in to significantly increase their positions in the domestic country. And also, they do it at a time in which the last thing they want is to take a FX risk. So I think that's key, and that's something that also these indexes should be looking at when they include countries or companies. Beyond that, I think again, I repeat, I think there was a last comment saying, look, asset price volatility is not equivalent to financial fragility or financial problems. That's right. I mean, we have to then map these effects into asset price volatility and potential financial fragilities. But the way some countries have reacted, they have reacted as if some of these shocks represented or generated significant financial concerns. And that's why they have triggered intervention mechanism, policy reactions, etc. So although not fully analytically and econometrically assessed, but by the anecdotal evidence during the taper tantrum, during some other episodes, we do see that they do generate policy anxiety. Maybe it's in the minds of the policymakers, maybe they're just being penalized by excess asset volatility, even if this does not imply financial problems, but they are reacting to these to these spillovers from global shocks.
There's a question also by Georges Jeu on whether the problem is credit or liquidity, but I think the point you made on domestic investors goes a long way to answer that question in terms of how to think about emerging market risks. One more question. I mean, one more thing I wanted your reaction, Alejandro, is this distinction between advanced economies and emerging markets, because looking at what happened in the last 10, 20 years, it seems to me that this distinction is less clear-cut than it used to be. And we saw Greece, we're seeing what is happening in a number of advanced and rich economies, which do include some emerging market type challenges, including in terms of the robustness of institutions. So can you give us a bit of your own thinking on whether the divide still makes sense and how to think about it going forward?
Well, I think, look, I think it makes sense, especially because, I mean, this divide also captures different fundamentals of these economies, like local savings, the need for, obviously, the need for foreign savings, forein financing, etc. As you said, the strength of institutions and the predictability of policy in the future. But as you said, obviously, and now let me maybe turn a little bit the question on its head, but as an emerging market policymaker, I think we always thought on designing policies and frameworks with a paradigm in which all the sources of of vulnerability and volatility were domestic. Really in the 90s, early 2000s, we never thought, let's build something to isolate ourselves from foreign shocks. I'm not saying that we should do it, but I think after 2008, 2010, and then COVID, and the way some emerging markets have moved of generating more stable macroeconomies and financial systems, thinking a little bit more how foreign shocks will affect your EMs, I think it's a relevant policy issue. Secondly, I think, and we tend to fall into that trap frequently, and we did it in COVID, we continue to look at emerging market problems as if they were domestically driven. And then we jump and say financial problems, debt problems. And when it's a global shock, we never think about the policy response in advanced economies generating a lot of liquidity. So I'm not saying that emerging markets are not much more vulnerable today because they have high debts after COVID, but it's true that we didn't have the number of debt problems that people actually said we were going to have during COVID, because I think we jump into the typical emerging market crisis framework, and we don't think that we're going to be flooded with liquidity as we were when we face a global shock. And I think those are two important, I think, things that we need to include more often in our toolbox.
Even saying that you were generous and charitable because you didn't mention the Eurozone crisis of the 2010s. I have a question from Paul Chu, who asks about how this is changing, especially in the context of COVID. He writes, we saw a great change in relative size of volatility and other risk measures and risk-adjusted performance, like Sharpe, around the world markets after COVID. Some emerging markets like Taiwan and South Korea demonstrate remarkable performance in terms of pandemic control. Can speakers give us any implication in asset management and in related research? It's a bit linked to what you just mentioned, Alejandro, but I'll turn it to Anusha.
Yeah, that's a great question. And I think it sort of, relates to this entire conversation we've been having about, we were talking about the strength and resilience of the destination country financial markets. But what we also see in the aftermath of COVID is that what I showed you was the initial rebalancing out of emerging markets, right? So if we sort of extend that, we sort of look after sort of May, June, it was very, very quickly reversed in the sense that emerging markets had, kind of blockbuster years last year with their stock returns, and the stock markets were booming. So while this capital came out initially, so we were focused on tail risk, tail shocks, and how capital can abruptly come out of emerging markets, what we see is that the capital flows did reverse, they went back into emerging markets. And there's other research to suggest that the COVID response, or the case arrival rate, for example, was driving some of these stock price reactions. So countries which were having, there was a more uneven impact that could have an impact on stock returns, but countries that had sort of good control over the pandemic, it certainly stood to benefit from the flows resuming. And then that just goes back to the more fundamental emerging market play, which is expected sort of returns that come from the growth prospects in countries like Korea.
Yeah, and with a question from Matteo Aquilina, which is about regulation, and maybe we would need a whole new hour about this of discussion, but he's asking whether the mispricing of liquidity, so to say, is whether it's driving the problem, and whether that can be solved by swing pricing or similar interventions in the regulatory framework or in the way instruments are designed.
Maybe I'll let Alejandro take this question, given his policy background.
Really, I have to think a little bit more. I think I think I'm not. I haven't thought about this. I think traditional way of trying to solve this. Yeah, it is a mispricing problem. It's a little bit of a imperfection in markets. Nobody is taking this opportunity unless local investors are doing it. And I think the way central banks have filled this gap is through intervention. I mean, accumulating significant international reserves when money is coming in, and then deploying it when market liquidity shrinks and this large pool of funds want to go out. And then the question I think we have had in the policy circles is which are the best intervention rules to provide more stability to markets. Should they be pre-announced? Should they be discretionary? Should you do it in the futures and option market and not in the spot market? So we have seen central banks enter the futures market, enter the spot market, doing it through options. And I think those are interesting discussions, and I haven't seen sufficient research as what should be the optimal response when facing, I think, these type of, let's call them foreign liquidity shocks.
Thank you. And with that, this was a very rich discussion. Thanks very much to both of you, because this is such a big issue and also a nuanced issue. And I'm mindful of what you said at some point, Anousheh, that it's not about throwing the baby with the bathwater, and the value of all these funds bringing money to emerging markets is something that has to be front and center in the analysis, but at the same time being very mindful of the risks, including for the global system. So thanks again. We're at the hour. Our next session will be in 2 weeks' time on January 26th. We'll be talking about the European banking supervisory system, how it works in practice. We had a session a bit more than a year ago with Andrea Enria, who looks at it from Frankfurt, from the center. We will look at it more from the spokes, not the hub, with Kilvar Kessler, who is in charge of banking supervision in Estonia, and Jonathan Zeitlin, who has done very interesting work at looking at the system from the inside in terms of evaluation of how it plays out in practice, as opposed to theory. In the meantime, thanks again to our two speakers, Anousheh Chari from the University of North Carolina in Chapel Hill, Alejandro Werner from Georgetown and Peterson Institute, and have a great rest of your day. And again, Happy New Year.
Thank you, Nicholas. It was a pleasure to participate.
Once again, it was really very rich and informative.
Thanks. Bye-bye.
Thank you. Thank you. Bye. Bye.